Question 61. A trader takes a short position in 25 futures contracts where the initial margin is 1,000 per contract and the maintenance margin is 800 per contract. If the margin account balance is 19,000 on day 10, the variation margin is closest to. So variation margin is going to be equal to our initial margin minus the margin account balance. And this is essentially the additional margin or funds that or equity that we would need to deposit if our margin account balance, so we've got margin account of 19,000. If that falls below our maintenance margin, we would get margin called, and then we would need to put up this variation margin in order to keep our position. So it's only needed if the margin account balance falls below maintenance margin. So our maintenance margin is 25 times 800, which is this original contract amount, and maintenance margin set, which is 20,000. So we can see at 19,000, we do breach that. And so we would need to put up that additional margin. And that amount is going to be calculated by this first formula up here. So we're going to do initial margin minus the margin account balance. So margin account balance is given at 19. Initial margin is going to be our 1,000 per contract multiplied by 25, where we have initial margin here. So 25 times 1,000, which will be 25,000 minus 19,000, gives us 6,000 as our variation margin. Answer C. Question 62. A hedge fund with 120 million of initial investment and a 2 and 20 fee structure, 2 and 20 meaning 2% management fee, 20% incentive fee or performance fee, earned a 35% return at year end. Assuming that management fees are based on assets under management at year end and incentive fee is calculated net of management fee. Net of management fee meaning we're going to take out the management fee from our AUM and then we'll calculate the incentive fee on the profits remaining. The total fees earned by the fund is closest to. So let's bring in my little table here and we'll talk through all these calculations. So management fee will be pretty straightforward. We're going to take this 120 million, multiply by the 35% return since we're doing AUM at year end. So that's going to be this portion right here, 120 times 1.35. And then we're going to multiply that by the 0.02 management fee, which will give us 3.24 million. Next, calculate the profits that we made, since this will be what we use to calculate our incentive fee. So profits is going to be the 35% return that we earned. Multiply that by 120 million AUM, gives us 42 million in profits. Since we're calculating net of management fee, again, remember that. It's important. We're going to take the profits, 42, and then subtract out this management fee of 3.24, and then multiply by our 20% incentive fee. So that's going to give us incentive fee of 7.752. And sorry, this should not say management fee. It should say incentive fee. Fix that on the fly here. So we've got our incentive fee of 7.752, management fee of 3.24. So all we need to do for total fees is add those two together, which we've got here down on our last line. Gives us just under 11 million, 10.992, which is going to line up right here with answer B. Question 63. Which of the following characteristics will most likely be considered as desirable by a private equity company seeking a target for an LBO, leveraged buyout? So considered a desirable trait, what would they want this company to have if they're going to buy them out using a lot of debt? A, inefficient management. This could certainly be a desirable trait. If management is inefficient, then that gives the private equity room to come in and make operational improvements, increase the profits and the cash flows, and essentially make the business worth more when they sell it in the future. So I think A will be our answer right off the bat. Let's make sure we can rule out B and C. B, an average ability to generate cash flows. We can rule that out. We don't want an average ability. We want above average ability to generate cash flows because we're going to be using a lot of debt in these leveraged buyouts. And so the company needs to be able to generate a lot of cash flow to pay off that debt service over time. C, companies perceived as being in favor in the general market. We don't want in favor. They are generally looking for companies perceived as out of favor. They're looking to come in and make value add. And so they want to buy out of favor companies, bring them back in favor so that they can sell at a higher profit in the future. Answer A. Question 64. In contrast to traditional investments, alternative investments are characterized by A, high absolute returns. They could be. That's normally one reason people will try and invest in alternative investments. They look at things like private equity or private credit that, in the case of private credit has higher yields than public credit, and in private equity can hopefully create some additional returns via leverage over public equity. So we'll leave that one in play for now. Not going to circle it yet. B, low degree of leverage. We can rule that out right away. These investments certainly have more leverage than traditional investments like stocks and bonds. And C, potential tax advantage. This one we can probably rule out as well. Between C and A, I think A is probably more so what the CFA curriculum is looking for, even though this is certainly not always going to be the case. There's very wide dispersion among private and alternative investment asset managers and across the asset classes. But high absolute returns is normally one reason that people will invest there. Potential tax advantage, real estate is really the only one, or if you're looking at some like tax-aware long short hedge funds, they could have tax advantages, but in general, private credit isn't going to be very tax advantaged because it's going to distribute high income, which real estate could potentially too. And private equity could have high returns, but that they also end up having some forced distributions, which you'll end up realizing gains. So they're not necessarily more tax efficient than traditional investments. Answer A. Question 65. Quantum Returns is a hedge fund with $250 million as initial capital investment. A 3% management fee based on assets under management is charged at year end, and a 20% incentive fee is charged on performance net of management fees. So like earlier, we'll take out this 3% management fee first, then we'll look at the profits and take that management fee out before we calculate this incentive fee. In the first year of operations, the fund earned a return of 16%. The investor's effective return given this fee structure is closest to. So what we need to figure out here is we'll take this beginning AUM figure, and what we need to find is after all these fees, what is that ending AUM? And then that ending AUM we'll be able to divide by our beginning AUM, subtract out 1, and do our normal return calculation, which is what I have up here at starting. So ending AUM less fees divided by starting AUM minus 1. So this is going to be our end game formula here. We need to figure out what ending AUM is, though, minus those fees. So starting with management fees, we're going to take this $25 million, multiply by the 16% return, which is what we have here, and then multiply that by the 3% management fee. We get 8.7, and that's million. So then our profits is going to be 250 million times 0.16. So we've got 40 million in profits. So then from here, our incentive fees net of management fees, we subtract out the management fees from the profits. So 40 minus 8.7, and then we take our profit or incentive fee off that, which is given to us at 20%. So we've got incentive fees at 6.26 million and management fees at 8.7 million. So next we need to calculate the ending AUM and then subtract out these fees. So ending AUM is going to be 250 times 1.16, and then subtract out 8.7 and 6.26 gives us net ending AUM of 275.04. And then we can just plug that into our formula, which we have down here. 275.04 divided by 250 minus 1 gives us a net return of about 10.02%. which will line up right here with answer B. Question 66. Which of the following is least likely a valuation method for private equity portfolio companies? So we've got least likely. So one of these is going to be the worst method, valuation methodology, and one will be the worst, 2 will be okay. So we've got cost-based approach, asset-based approach, and discounted cash flow method. Discounted cash flow we can rule off right away. This is a lot of times what will be used for these private equity portfolio companies. Cash flow is a very important part of private equity investing, so it can often be used to value those businesses. So then between asset-based and cost-based approach, these are both going to be based on assets on the balance sheet, essentially. Cost-based is looking more so at what would it replace to cost, or what would it cost to replace the assets that we have. Whereas asset-based is going to be looking more at the fair value of those assets today. And so between these two, they're obviously very similar. So we need to determine which is worst. I think in the case of both, they're not really going to be ideal for valuing these types of companies. However, for asset-based approach, this will be used a little bit more commonly among distressed managers, since they're going to be buying the companies and then essentially kind of selling off the assets. And so knowing what the fair value of those assets are, they're able to market the company as worth a certain amount based on that. So I think between these two, neither are great, but cost-based approach is going to be the worst. So we'll go with A. Question 67. European put and call options both have an exercise price of 50 that expires in 120 days. The underlying asset is priced at 52 and makes no cash payments during the option's life, and the risk-free rate is 4.5%. If the put is selling for 380, what should be the call option's price given that no arbitrage opportunity exists in this market? So we'll be using our put call parity formula to solve this. We are looking at the value of the call. And so what we're going to do is move this whole variable over to this side, and then we're going to solve. So we're given the put at 380 and the underlying at 52. So we can see those plugged in right here. And then the riskless bond portion, which is going to be this whole variable, X is going to be our strike price, and then we're going to discount that back at the risk-free rate, so 1 plus 0.045, and then raising that to the T, we expire in 120 days, so T is going to be 120 divided by 365. Since this risk-free rate is an annual rate, essentially that's why we do that. So when we run those numbers, it comes out as 6.5184 for the call option cost, or the call option price, and we can round that. Go with answer C, 6.52. Question 68. Which of these statements is least likely correct regarding an option? So least likely correct, so 2 of these will be correct and 1 will not be. A, an option's market price equals its intrinsic value plus its time value. We can rule that out since that is a correct statement. The intrinsic value is essentially, and the difference between the intrinsic value and the option's price essentially is the time value, and the price is always going to be above that intrinsic value as long as there's positive time, and then as it converges closer to the expiration, that intrinsic value should be similar to the price. B, an option's intrinsic value equals its market price plus its time value. So we can go with this answer because it contradicts what we said in answer A, and we determine that price equals intrinsic value plus time value, whereas this is saying intrinsic value equals price plus time value, but it would actually be price minus time value. And then answer C, an option is a contract that gives the buyer, the owner or the holder, the right but not the obligation to buy or sell an underlying asset at a later date. That is what an option is, so we can rule out C, confidently go with answer B. Question 69. A European put and call option both have an exercise price of 50 that expires in 120 days. The long forward is priced at a forward price of 52, also expires in 120 days. It makes no cash payments during the option's life. The risk-free rate is 4.5%, and the put is selling for $3.8. The price of the synthetic call is closest to. So we're given all the variables here. We're going to be using our put call forward parity formula. We've got the put price, we have the risk-free rate, the forward price, and exercise price. Essentially, for the put call forward parity formula, we're substituting in the forward variable instead of the underlying variable. So we end up plugging in this 52, and the biggest difference is we're going to be discounting that back to the future. So when we're just looking at the underlying, we're not discounting that, but if we're looking at a forward contract as part of this parity formula, then we are going to be discounting that back. So for the call option, to calculate that, we need to move this whole variable over to the other side. So we subtract that from both sides and it becomes a negative value. And then from here, we're just plugging and playing. So for the put, we've got 3.8. And then for the forward, this is this whole this whole part right here. So we're going to have 52 plugged in for that price. And then we're going to discount that back at 1 plus the risk-free rate. And we're discounting that back for 120 days, which is our expiration. And we'll do 120 divided by 365. And then it's going to be similar, almost the same exact calculation that we're subtracting for the riskless bond component, which is going to be that exercise price of 50 discounted back. at the risk-free rate for 120 days. And when we work that through, we get 577.13. We have negative 577. That's not going to be right since we have positive 5.71 and C positive 5.77. Question 70. Which of the following is least likely a category of alternative investments? So least likely, so 2 of these will be alternatives and 1 will not. Answer A, collectibles. We can rule that out right off the bat. Since collectibles are certainly alternative investments, they're not going to be publicly traded and they're not usually part of a traditional investment portfolio. Then we've got B, infrastructure, and C, supranational bonds. So technically there is publicly listed infrastructure, but I think looking at the least likely answer, or the least likely included in alternatives between infrastructure and supranational bonds, I think we would go with C, the bonds, as being a more traditional investment type relative to infrastructure. Even publicly available or listed infrastructure would probably be considered an alternative investment. It generally has lower correlation to stocks and bonds. And bonds generally are going to be more traditional investments. So we'll go with answer C.